Joel Greenblatt's hedge fund returned an average of over 50% per year for over 9 years. The S&P 500 returned about 9% per year in that same period, including reinvested dividends. So, how did Greenblatt achieve such phenomenal returns, before ultimately closing off his fund to new money? Of course, he did what any of us could do. He bought low and sold high. Okay, he did a little bit more than that, but seriously, his methods are unbelievably simple for such high returns. Greenblatt's preferred investments come from what are called special situations. Corporate spin-offs are one type of situation. A spin-off happens when the parent company wants to get rid of part of the business. Usually, it's in the shareholders' best interests. Spin-offs can happen when part of the business is unrelated to the parent business, or when it's a lower quality business with less than favorable financials. Great. Spin-offs are meant to help shareholders, so everyone wants in, right? Not exactly. When a large company spins off a part of the business, all shareholders are given stock in the new company. Institutional investors usually can't hold investments with smaller market caps or even stocks in different industries. The result is that the spin-off business's stock price usually gets beaten down by institutional investors and other large investors selling their shares because they have to, or because it's not a part of their original investment. So, most of the time, you get a stock that's irrationally trading below its intrinsic value. Of course, simply seeing a price drop doesn't mean it's a good investment. Joel Greenblatt looked at the pro forma financial statements of the spin-off and tried to see what its future might look like. Discounting the future cash flows of the spin-off at a reasonable discount rate, he figured out what the intrinsic value of the spin-off was. He also looked at other stocks in the industry to see how the market is currently pricing them. To further analyze spin-offs, he looked to see what insiders were doing and checked how much ownership they had in the company. You can recreate these steps too. Spin-offs are rare but not unheard of. There's spin-off situations happening all the time. When you find a spin-off, after figuring out your best valuation, you may have just found yourself a gold mine. Just like spin-offs, mergers are special situations that Joel Greenblatt loves to explore. Unlike a spin-off, instead of cutting out a piece of a company, mergers combine two companies. Sometimes, the buying company pays the shareholders of the other company in an all-cash transaction to acquire them. In other times, the buying company uses cash and what are called merger securities. Merger securities can be anything from company stock to debt to other wacky combinations of these two, some of which we'll discuss in the next section. Basically, when the first company doesn't have enough cash, it gets creative with its financing. However, just like spin-offs, the other company's shareholders may not be huge fans with changes in their original investment. Again, some institutions or large shareholders that own stock in the company being acquired either can't or don't want to hold stock or securities in another company. So, this could lead to irrational selling. Greenblatt pays extra attention to mergers with more than cash and pure stock being transacted. Some buying companies might also use sophisticated debt or equity securities to pay for the merger. These securities usually have smaller markets and therefore less liquidity for large investors. So then what happens? You guessed it, more irrational selling, and one happy Joel Greenblatt. So, let me propose a situation to you. You're thrilled, ecstatic actually. You found a spinoff, and you did your due diligence, and you think that it's trading way below intrinsic value. Good for you. Classic Greenblatt move. However, you know it's cheap, but you also realize it's heavily leveraged. With so much debt, you know there's a chance it could go bust. But with debt comes the opportunity for extreme upside. After all, if a company makes $5 and the debt is $4, you get $1. If it makes $6 the next year, only a 20% increase in sales, your earnings just doubled. One way to be a part of a situation like this and limit your downside is to use options, specifically long-term equity anticipation securities, or LEAPs for short. LEAPs are when you buy a call option for close to 2 years in advance of expiration. Being a call option, your downside is only limited to the amount you pay for the option. But you'll get the full upside if the stock price goes up. Perhaps an example may help. If a stock is trading at $5 and a LEAP call option is trading at $150, you can buy the LEAP, and if the stock moves up to say $8 per share within 2 years, your LEAP will be worth $3 more or triple its original value. However, if the stock goes bankrupt, you're only down your original $150 instead of the $5 you would be down if you had instead bought the stock. Of course, this is just scratching the surface, and I recommend much more research into options because they are complex derivatives that can certainly ruin an entire portfolio if not used correctly. Another type of security that's similar to a LEAP call option is what's called a warrant. Warrants give the holder the right to purchase a stock at a specific price. Just like a call option, the holder gets the upside if the stock goes up, but is limited to the downside of the price that they paid for the warrant. Even better than a call option, warrants usually have a lot longer time period than 2 years, so you could basically have a LEAP call option that lasts for 5 years or more. This means 5 years for the stock to reach your estimation of its intrinsic value. Warrants are rare and are only issued by the company, but you may come across them in your search for special situations. Greenblatt used leaps and warrants for all kinds of special situations, which lowered each investment's risks compared to the potential rewards. Joel Greenblatt advises investors to use some of his strategies if they want to make significant returns through these special situations. One strategy he uses is called diversification. Many of us are told that the more baskets we have for our eggs, the better. It's always better to have more exposure, right? Not so, according to Joel Greenblatt. See, since special situations are so, well, special, you really shouldn't have more than 8 or 10 in your portfolio. It's very unlikely that more investments would be better than the first original 8 or 10. If you know the most about 8 companies and think that they are the best you have found, what's the point in adding some subpar players to your roster of all-stars? Greenblatt brings up research that shows that after about 10 stocks, you have just about as much systematic risk as if you held 30, 100, or even 500 stocks. Therefore, as an active investor, it isn't necessary to hold more than this amount in your portfolio, unless you find over 10 equally attractive investments. According to Joel Greenblatt, what distinguishes a great investor from an amateur is how they look at risk. Sure, everyone wants upside, but at what cost? Would you buy into something with a 10% upside, but an equal chance that you would lose 100% of your money? Perhaps you would in Vegas, but hopefully never as an investment. Great investors limit their downside risk as much as they can and create the most upside from these situations. It's extremely important to only invest in situations where your potential reward far exceeds the risks of getting it. Greenblatt achieved a 50% return per year through a combination of deep analysis, risk avoidance, and frankly, pure luck. He didn't win every time, but he certainly positioned himself to win a whole lot more than he lost. Don't trust anyone over 30, and don't trust anyone 30 or under. Perhaps Greenblatt's most useful advice. Don't trust me or him. Use this information however you'd like. Figure out what works for you and go catch yourself a 50% return. I hope this helps. Please leave a like and subscribe if you want more. What investor do you want to know more about? Leave a comment down below, and I'll see you again next time.